Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending October 14th, 2022. Looking at the market indexes for the week, the TSX, S&P 500, NASDAQ, and Russell 2000 were all down a little bit for the week, with the Dow Jones the only index up slightly. Oil was down significantly and gold was down as well. The big event of the week was the US Consumer Price Index data, or the reading on inflation. The core CPI month over month for September came in at 0.6%, higher than expected, and at 6.6% year over year, also higher than expected 6.5%. The headline inflation was 8.2% year over year, higher than the 8.1% expected, but lower than the previous month's reading of 8.3%. So we are trending down, albeit slowly. Just to make you aware, the difference between the headline inflation and the core CPI is that the core CPI does not include the volatile pieces of food and energy. Now, after these readings, the stocks posted a major historic rebound on Thursday. The S&P 500 snapped a 6-day string of losses. Meanwhile, the Dow Jones Industrial Average rallied more than 1,500 points from its lows to its highest level during the session, closing up more than 827 points. The Nasdaq Composite also rebounded from a 52-week low to end with a gain of 2.23%. The remarkable turnaround on Thursday came after stocks slipped to session lows following the September Consumer Price Index report, which came in hotter than expected. The knee-jerk reaction to the news stemmed from fear that persistent inflation would mean a more aggressive Federal Reserve. The sentiment reversed once traders digested the report and realized not much had changed. The Fed is still on pace to hike rates by another 3/4 of a percentage point on November 2nd, likely followed by more increases. Stocks, which were oversold, picked up after that. That same week, the US jobless claims were slightly higher than expected. Turning quickly to China, the thinking is that if China is going to invade Taiwan, the clock starts ticking once President Xi enters his third term later this year. He wanted everything peaceful prior to his confirmation, and those meetings begin this Sunday. The price of oil is dependent on China's recovery and the OPEC production cuts that happened recently. If China recovers in the near future and increases demand, oil price will continue up. American households are taking on more debt as rates rise. Once COVID payments stopped, the US consumer kept spending, which is good, but this time on credit, which is bad. The Bank of Canada's interest rate hikes managed to cool the housing market a few degrees in Canada, but they also strapped mortgage rates to a rocket. The average home price in Canada dropped 3.9% in the past year. Meanwhile, the average 5-year fixed mortgage rate jumped from 3.2% to 5.58%. If you put 20% down, that means the $2,500 a month mortgage payment that got you a $650,000 house last year is only good for $500,000 house today. With TIF hell-bent on raising rates till inflation gives in, there's more pain ahead for homebuyers. The consensus is that US and Canadian central banks will need to continue raising rates to raise unemployment and lower demand until a recession happens. This is the only way to lower inflation. If the unemployment rate is still low, for example, demand will continue to be high as people with jobs spend money, and so will wage inflation remain high as employers compete for employees. We also had news from the US wholesale prices, which rose 0.4% in September, higher than expected, and the producer price index came in hotter than expected as well, sending US stocks on a roller coaster ride early in the week. Later, stocks ticked up briefly after a line in the Fed's Wednesday meeting minutes signaled the central bank may back off rate hikes if financial markets continue seeing turbulence. Overall, however, the minutes showed the Fed intends to keep hiking interest rates and they'll hold them higher until inflation meaningfully cools. Also, keep in mind neither central bank has stock market stability in its mandate. We found out this week that Credit Suisse is not Lehman Brothers 2.0. Quick recap. The enormous Swiss bank saw its stock plummet and credit default spread, which is the market's take on chances a company won't pay its debts, spike. Twitter got all the Twitter, and people talked like this was the first time in a new line of 2008 style dominoes. While it's true the bank lost billions last year and will go through some pain as it covers its losses, the company says it has a 100 billion US buffer, and just as importantly, no other banks are at risk. In other news, the US forbade, in an expansion on previous prohibitions, sales of supercomputer chips and memory chips to China, which hurts American semiconductors. In somewhat unfortunate news, the International Monetary Fund said on Tuesday the world growth will slow and average 2.7% in 2023, and things will get worse as we get into a world recession. The IMF fund is warning that, quote, the worst is yet to come, unquote, for the global economy. It predicts growth will slow to 2.7% in 2023, 0.2 percentage points lower than its previous forecast, and will, quote, feel like a recession, quote, for many. Russia's invasion of Ukraine, an economic slowdown in China, and decades-high inflation are expected to stunt growth, and global inflation is forecasted to peak at 8.8% in late 2022 and remain elevated longer than expected, until coming down to 6.5% in 2023 and 4.1% in 2024. So time will heal all wounds. As interest rates have come up in US and Canada, bonds and other fixed income have become a viable alternative to stocks with higher yields. During a recession, stocks may come off, but bonds will continue paying the interest. So something to look at. The upcoming Q3 earnings season will likely be okay, is what analysts and investors will look for, will be what the CEOs say about their 2023 outlook. Major US banks and financial institutions kicked off their earnings season reports in a flurry Friday morning. Wells Fargo, JP Morgan Chase, Morgan Stanley, Citigroup, and PNC Financial Services Group all released quarterly results. Performance for the period was mixed despite big increases in interest revenue, obviously. Banks are facing greater liquidity constraints and are having to fund loan growth with higher cost deposits, debt, and security portfolio runoffs. Rapidly rising interest rates and higher capital requirements are leading to an accelerated upturn in the credit cycle, heading into a period when loans are more costly and difficult to obtain. That puts financial institutions with excess capital, liquidity, and positive operating leverage in the best position long term, however. Turning to next week, companies reporting next week include on Monday, there's more US big banks reporting. Tuesday is Netflix and United Airlines. Wednesday is Tesla and Procter & Gamble and Alcoa, an aluminum giant. Thursday is AT&T, Blackstone, Whirlpool, and Canada's Mullen Group. Turning to economic events next week, we have China's National Congress kicking off Sunday, October 16th, where President Xi is likely to be given a third term. It will be a stabilizing event, removing uncertainty and allowing Xi to take steps he may have been hesitating on, such as the aforementioned Taiwan question. Wednesday, Canada has its CPI numbers for September. 6.8% year over year is expected. Also on Wednesday, US has oil data such as inventories and imports. Thursday is US jobless claims. That concludes my observations for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.